Welcome to episode 33 of Full Throttle, the Presidio Group's automotive industry podcast. I'm your host, Jason Stein, director of multimedia and events at Presidio. On a regular basis, Full Throttle serves as the industry's meeting point for great conversations with leaders across the automotive world.
Direct assaults have really been pushed back, and I think for good reasons, not just regulatory or legislative reasons, mostly. The underlying system continues to mutate and modify, of course. And then what has been more successful is the stuff that gained ground while we weren't looking. The independent aftermarket and parts and service, the big collision repair chains, and the big used car chains. And that's ground I think the industry needs to claw back.
As it is written in Presidio's latest quarterly report, the dealer model is constantly in question and continually challenged. Direct-to-consumer models from startups seem to always be a threat. Glenn Mercer has been at the forefront of predicting dealership viability and vitality. He's often provided the context for what's coming or what's to come in the auto retail space. An independent automotive researcher and industry futurist, Glenn is the author of the insightful Dealership of Tomorrow report. He has over 35 years of automotive experience, participating in hundreds of client studies. In addition to project work for investment firms, he's been an advisor to industry entities such as NADA and NAAA, an expert witness in automotive cases, and a lecturer on automotive economics in academia. Prior to beginning his automotive career at McKinsey, he worked at the Central Intelligence Agency and then at BP. He's been president of the Society of Automotive Analysts and director of the International Motor Vehicle Program. Today, Glenn appears on Full Throttle to discuss industry disruption, the direct-to-consumer model, and the future of the retail industry.
Hello, I'm Glenn Mercer, and this is Presidio's Full Throttle podcast.
Glenn, what a pleasure to have you on the program. Thanks so much for joining me.
Sure. Happy to be here.
Let's talk a little bit of context to start off with for the listener. Explain to us how long you've been studying the dealership model and maybe the factors that are thought to be the disruptors to that model.
Right. The only thing I'm certain I bring to this discussion is my age. There's no denying that, unfortunately. And so at age 69, I think I did my first McKinsey and Company junior consultant project in the dealership world in the mid-1980s. Our automotive practice there was mostly focused on OEMs and suppliers because you had to be very unprofitable and very large in order to afford McKinsey's fees, whereas downstream, including dealerships and things, it was neither large nor unprofitable. As Jack Nasser at Ford said years ago, maybe apocryphally, we make cars, everybody else makes money. So I had focused on the downstream end, which would be everything from insurance to recycling to the aftermarket to dealers. So starting as far back as the 1980s, I've been able to observe over that time, I'm going slowly here because I realize it's not just the last century, that's the last millennium. So let's call it 40 years. That time after time, various knights on horseback have sort of charged the castle gates of the dealership system in the United States. And the castle seems to be fairly well intact. Cynics say it's all due, of course, just to state franchise laws. And my response is, those are pretty powerful laws since they seem to cover 150 other countries in the world, which pretty much all use the dealership system. But we've seen, I was jotting down a few notes, I think we've seen at least 6 runs at the castle in that period of time as people circling it say, how do we get a share of this revenue and profit? So we had the... do you mind if I list the ones I just jotted down?
Please do.
Sure.
Yeah.
We had the forward integration attempts by both Ford and General Motors way back. Ford went further than GM did. GM pulled back before they really launched. And I think the lesson learned there, and we've seen it in Europe as well, is that company-owned stores by the OEMs are very difficult to make very profitable for a bunch of reasons. And even companies like Mercedes, which has been pushing hard on the dealership model through the launch of its agency variant, itself has sold pretty much all of its own stores in North America. in Canada, for example. Then we had the online disintermediators, probably an early iteration of TrueCar and Cars to Go, I think, who somehow are going to get in between the factories and the dealerships and pull all the good cars and sell only them. And that sort of ran aground on the shores of the allocation problem, which is A, you're not a dealer, and B, if you want the good cars, you're going to take the bad ones too. Then we had Wayne Huizenga and the public chains. Of course, Cross Country launched before AutoNation, but I think it really was Wall Street's love affair with Wayne Huizenga, who had made such great successes with Waste Management and Blockbuster. Said, I'm going to do it again with AutoNation, and the publicly owned chains would have the scale and the skills to wipe out private dealerships. And while the 6 or 7 of them have survived and thrived, they're still, sort of 10% of the industry. So that kind of that wave receded. Then we had, of course, Tesla and direct to customer, and others who have followed along, like Lucid, and then in Rivian, of course, quite a few in China, et cetera, et cetera. And I would say that works, but the auto industry tends to be one that wants to know in black and white what is the single best answer versus the wrong answer. And I think in a black and white world, no, I'm not going to say it works. It works in certain situations. I think mostly for higher priced vehicles where demand exceeds supply. And frankly, when demand exceeds supply, you can sell any way you want. You can raffle cars off or drop them from blimps. I mean, Ferrari could do anything it wanted. They could have people arm wrestling in an arena to get the next, whatever it is. So a direct to customer, I'm not going to rule out as impossible, but I think it's we've seen that it's an exception as opposed to a role model, because it doesn't work well when supply exceeds demand, and that's kind of the last 150 years of the car industry. As a footnote to that, I wish all of our channels and all of our OEMs could sort of tone down the rhetoric here, because when I look at other retail industries, they use mixed channels. McDonald's owns stores and franchises stores. Starbucks owns most of its stores and licenses others, and they sort of coexist. Our industry, insists on one right answer, and I think there's actually multiple right answers that can coexist. For example, I was just in the UK, where one of the largest dealership chains is owned by Ford, and they seem to get along with their dealers. Then, of course, the most recent run at things has been agency, which, if one is cynical about it, which is the halfway house between direct to customer and franchise dealership. And if one's cynical about it, one would say that in the run-up in dealership profits during the chip shortage and the pandemic, OEMs was trying to figure out a way to grab some of that margin, understandably. But again, the appetite for it cools as demand shrinks below supply. And now, I don't think there's too many OEMs who want to hold on to that much inventory. That being said, again, I want to be objective about this. Mercedes, especially in Europe, has moved to pretty much all agency. And I've talked to dealers who are now agents, and for some, it's worth the trade-off, right? Which is, on the one hand, I don't get as much margin as I used to. Then again, that margin was falling anyway. I get just a commission, which doesn't make up for the margin I've lost. On the other hand, I have no floor plan cost of any kind. I don't haggle the price. And, so my cost position drops. And I know on a recent earnings call, Brian DeBoer even said, hey, if agency comes to America, we can live with that. So I think some dealers, especially smaller dealers, might really be interested in making this swap. If you're making most of your money in the back end and fixed ops, and you want to be relieved of this rat race trying to price and pursue consumers and hold stock, might work out. But anyway, so that's, by my count, at least 5 sort of attempts to I'm going to use the D word here, be warned, to disrupt the system, and have, I guess, the best of them are sort of a draw and most of them are a fail. And I think this just comes back to the incredible resiliency of the dealership model. First, it's the right model. You want distributed inventories owned by people who are highly motivated to get them sold. And that's why we have dealerships in a nutshell. And then secondly, it is a system that is extremely adaptable and flexible. I know there's sort of a theme out there that somehow dealers don't like change. I don't know if they dislike change more than any of us, that's human nature. But when I look at how they've pursued F&I income, which was a sideline in the past, how they've grown to professionalize used cars, which again used to be a gravel lot and a double wide trailer in the back, how they've computerized and digitized. Long way to go, but they've been kind of changing operations at quite a clip. So I think they're pretty adaptable. Where I think runs at the castle have been more successful, if we're going to stay with the castle metaphor just for a little while longer, is people who've charged in through the back door while no one was watching. What I mean by that is the frontal assault on the system has been pretty much beaten back, but less frontal assaults have actually worked out pretty well. So, for example, people have said, let's not charge after the new car showroom, and inside and outside the industry, there's a tendency by many people to define the dealership as new car sales. And as you know, and everybody else knows who's listening to this podcast, it's all about used F&I, after sales, and collision repair. And those areas, interlopers, whatever you want to call it, have been more successful. I mean, from day one, the independent aftermarket has gone after repair and maintenance work, and indeed has 70% of the market. Dealers only have about 30% of that. So, and a lot of that was by going after the stuff that didn't require diagnosis, because diagnosis is a pain. You usually don't get paid for it. You can get it wrong, and it takes a lot of time. Whereas, with Jiffy Lube, they said 10,000 miles went by, get your oil. With Goodyear, it's your tires are flat. I think you can find that out for yourself. Bring them in. If you just drove through the back wall of your garage when you came home, that means your brakes are bad, and you'll go do that. Or back when we had mufflers that burned out, the neighbors would call you and tell you needed a muffler. So the aftermarket peeled off all that stuff and did a very good job. Collision repair, I don't have good data on how big dealers were on collision repair in the past, but that's mostly migrated away from dealers, though there's a move now to migrate back. And then, of course, used cars, where there's always been used car dealers. By the way, if any of your listeners know anything about the industry, I'd love to get in touch with them, because nobody seems to know how many there are. I've talked to people who said there's 20,000, 30,000, and 100,000. And I know it's easy to get in because you just pay $300, get a license and a banner, and you're all set. But leaving aside, those guys have always been around. Of course, CarMax is the shining example here of saying, you guys are under-managing used cars. We think their quality is good enough now. We can package them up and merchandise them as goods on a shelf, like stereos or furniture, and not have, they're no longer just lemons that we're trying to get out of here before the customer realizes what they've bought. And then Carvana taking it further and working on the front end. What hasn't been peeled off, and there were a couple of runs at it, was F&I. I think it was like Lending Tree and a few other companies, the first sort of retail fintech companies 20 years ago, saying, qualify your credit with us, and then we'll have you print out a certificate saying you've got a $15,000 loan from Lending Tree, bring it to the dealer and say, this is what I'm going to use to finance the car. And that's been pretty much pushed back, as dealers can always get the last look, and they can always beat the deal. So anyway, to sum up, and then I'll stop ranting and let you get a word in edgewise. Direct assaults have really been pushed back, and I think for good reasons, not just regulatory or legislative reasons, mostly. The underlying system continues to mutate and modify, of course. And then what has been more successful is the stuff that gained ground while we weren't looking. The independent aftermarket and parts and service, the big collision repair chains, and the big used car chains. And that's ground I think the industry needs to claw back. Mm-hmm.
Back about 7 years ago, you talked about what the future dealership would look like. We're almost, and your prognosis was to 2025. Yep. What did you get right? What did you get wrong?
Right. That was done because NADA, listened to the joke that for a dealer, the future is the end of the month. They really wanted to look further ahead for their members. And
Right.
so what do we get right and what do we get wrong? I think I was right on that autonomous vehicles were a long way off and we would not be all in robo-taxis by 2020.
You
I think
did
I
say
got,
that. Yeah.
yeah, I think I
Hmm.
got right that ride hail would not be a threat to personal ownership, that
Yep.
we'd all
That's
be
another one.
Ubers, right? Yeah. Um, let's see. Then electric vehicles just were not really on the map at that point in time, so I'm not sure I had a huge prediction, but if I did, it was probably wrong in that I was thinking of electric vehicles mostly as either very low-end urban runabouts like Leaf or exclusive high-end Model S Teslas, and didn't see
Hmm.
just how big the regulatory push would be in that direction. I think if I won't go through all the exterior factors, but if we look at the internal factors, I think I missed the F&I upward trajectory. I think I underestimated just how much more F&I per new unit retailed we could get to by professionalizing F&I, by cleaning it up, better products, menu selling, IT, and things like that. So I missed that, I think. Um, that's just a few things, but we can go
Yeah.
into more detail. But that's
Sure.
got a few wrong for sure.
Well, I think you got a lot right, actually.
Some of the big ones wrong,
Dealers
maybe.
dealers who responded to Presidio's surveys have consistently said that direct sales and the agency model that you just mentioned present some of the biggest risks to the traditional franchise dealer model in the long term. What do you see as the real risks for dealers presented by direct sales and agency models in America?
Yeah. On agency, I guess I'd have to say it's I'm more neutral on agency. That is, I can see the deal. That is, you don't get margin, you get a commission, but we take off your balance sheet, all the inventory, and you're no longer responsible for setting the price. And I can see that trade. And I've talked to dealers who become agents in Sweden, New Zealand, South Africa, etc. And I have to say, if I'm being neutral and objective, which I strive to be, agency is maybe not always inherently bad if you're starting as a dealer. On direct to customer, I think, again, I'd say, and by direct to customer, most people immediately leap to Tesla, and which may be a bit of a mistake because Tesla's such a unique unicorn. But direct to customer, I don't see as having much of a future in the mass market because I think it's the wrong system. So I think objectively it's the wrong system. Now we can get into all the state level battles and state houses and legislators and stuff like that, et cetera. And it's complex and messy and very emotional, I understand, on all sides. But the trouble with direct to customer is, and on my blog, I wrote this up a bit, is again, once supply gets to be greater than demand, direct to customer backs up with unsold product. And the only way to get rid of it is to cut price.
Right. Exactly.
So if Tesla's got 100 cars they need to sell and they've got demand for 90, just move the last 10, they cut price, but it's on all 100. And we've seen what it's devastated their margins. Whereas with a dealership network, the dealer essentially is like that sorting hat in Harry Potter. This customer needs an over allowance on the trade-in. This customer needs to switch to a different trim level. This customer will buy if we throw in the floor mats. This customer needs a different financing source. Dealers get the deal done. It's in their name. And because it's an expensive thing to buy and it's almost always a complex purchase, I think the dealer system is just superior to direct to customer in an environment where there's supply piling up at the factory and we've got to move it.
So what are the existential threats then, as you see it?
Um, uh, at the risk of being the person who says, I don't think there's an existential threat just before the asteroid hits his house, I am not sure I can see an existential threat to the dealership system. I
Hmm.
can see it being less profitable in the future. But if we just talk about America, not anywhere else, we're mobile. I'm sorry, we're not stopping driving. We're still inching upward in cars per household, even though we've got more cars than we've got driver's licenses. We can't even drive them all, right? What is it, 290 million on the road or something? So,
Right.
given, I think, I have a personal belief that we're not all going to just move into urban high rises and not move around anymore. So, if we've got a demand for mobility, and over again, it's been shown when people have the ability, that is the money, they don't want to share. They don't want to carpool. They do not want to ride on mass transit, et cetera, et cetera. So they want their own car. So we've still got our own car. If we believe, then we have demand on that side. And on the supply side, the unfortunate reality of factories, even Tesla's, is their break-even point sort of 80, 85%. It isn't just the factory, it's all the suppliers feeding the factory who can't lay off in August and rehire in September and lay off in October again as demand fluctuates. They want to run steady, demand goes up and down, the dealership system buffers it, and it exists. And
Good.
the one other thing, sorry, I'm tramping on you here, but
Sure.
I'll say the
Sure.
one thing that no dealer and no OEM will ever say, the dealership system is good at selling cars that people don't really want. Every once in a while, a company will make a car that is not exactly desirable, and somebody's got to move it. And in a direct-to-customer environment, it doesn't move unless you just slash price into disastrous levels. So
Right.
I think the
Right.
system stays intact, at least for the rest of my lifetime, I guess.
Yeah, and we've seen that example of plenty of vehicles that very few people wanted that needed to be moved for sure.
Yeah.
As you consider other as existential threats, how about the view of the Chinese EV makers? And could they change the industry and could they change the dealer model in America?
Um, yes, they could change the industry, and yes, they could change the dealer model. Impact, of course, is they're the people to accelerate the EV transition, which right now is sort of bumping along in a kind of a plateau in America. But cheap cars that go 600 miles or whatever and are pretty high quality, that changes the game. That being said, nothing unites Democrats and Republicans more alike. They don't like China. And so we have this tariff wall, and people who say, yeah, well, tariff walls are permeable, I point them to the chicken tax of 1964, which is still on the books and still protecting our pickup trucks. But where do we go if I kind of go past the politics and things like that? I wrote a letter to Automotive News recently, and they published it. They must have been desperate, saying when the Japanese showed up, we had this existential crisis, and we did some quotas and things, VRAs, remember those, and we JV'd Ford, Mazda, Chrysler, Mitsubishi, and GM, Suzuki, Subaru, etc., and figured stuff out. A lot of missteps along the way, but we had Numi, and we had what's the plant, Normal, that Five Star, whatever it was, in I'm getting it wrong, in Mitsubishi in Normal, Illinois, and then we figured out a new level of coexistence. Did the big three lose market share? Yes, they did, but we survived. The Koreans showed up. Same kind of thing. I would guess that GM bought Daewoo, right? I would guess that this time around we would see a similar mix of solutions, tariffs, quotas, etc., and then JVs. BYD signs up with somebody who provides them diplomatic cover, and then they eventually build a plant here. Will the domestics like this? No, they won't, but we'll get by and survive. And by the way, now, will they use dealers? Well, if I were a money-losing EV maker in China, desperate to sell in the United States, and I was facing a $100, $200 million homologation bill and legislative pushback, wouldn't I want to use a ready-made distribution system that already exists, or do I want to spend another $100 million and develop my own? So I think if they're rational, they will mostly use dealers. Could be wrong, but we see even in Europe, some of the ones that came in direct have now mutated to using dealers.
Couple of final things, Glenn. You've talked about rebounding inventory numbers being a factor that favors dealers as an option. The
Yep,
idea that if automakers have hundreds of thousands of vehicles in transit and already on
yep,
the books and needing to be sold, then their views on dealer on dealers changes.
Sure.
The industry got a bit of a taste of how a demand pull kind of production system could look during the pandemic, but
Mhm.
we've seen that now revert, at least for many brands, as
Yeah.
production constraints have
Yeah.
gone away,
Yeah.
right?
Yeah.
Obviously.
Yeah. Yeah.
What keeps the US industry from making a demand-based system work?
Okay, so you're right. If dealers are sort of at 6% ROS during the peak years of the chip shortage, and now we're back to two, we're headed back towards the historical level of 2. We're hoping, can we stay at 2.75 or 3? We are seeing the OEMs exert more discipline. We could sell 17 million cars pretty easily, I think, again, and we're at 15.5, which is not much down, by the way. But we do see some OEM discipline, certainly Toyota, et cetera, and Honda, who've always had the kind of discipline. I think there's one factor positive, one factor negative, and I'll try to be fast about this because I do tend to rattle on. The positive factor is everybody has seen what supply discipline does. So they can no longer speculate as to whether it's a good idea. It's a good idea. The negative is, unfortunately, our break-even points are not lower than they were. That is, the factories and the supply base still kind of have to run. And people say, doesn't automation help with that? It does exactly the reverse. If you replace people who you can lay off with robots who you can't, you actually raise the break-even point. And if you're spending billions on autonomous and electric vehicles and things, you've got to fund that somehow too. So I don't know. I think that I'm hoping that the balance sorts out where we are, like 15.5, and dealer profitability maybe between 2 and 3, and OEM profitability okay. But if we just look at history, we'll revert to the mean. That being said, the mean for American dealers, the average, is not a bad average to be at. 2019 was not a bad year.
Right. Final thing, you're going to be
Mm.
presenting at the 2025 NADA show again,
Mm-hmm. Yeah,
Dealership of the Future, and that's coming up in January. Give
right.
us a sneak peek of what you want dealers to take away from that conversation.
Actually, I've got 3 presentations. Don't worry, I won't take a half hour on this. There'll be something on Dealership of Tomorrow, and there again, it'll mostly be calm down, we're going to be okay. We will also be presenting on the Cost of Distribution project, which was just released at the Automotive News World Congress, on the relative economics of these different channels. I won't go into more detail, but we'll recap that. The third thing is what I'm working on right now, and if any dealer wants to contribute, get in touch, please. And that is called Back to Basics. As we suffer trend fatigue in the United States and as we revert to something more normal, a lot of dealers have been asking NADA about how do we rebuild our skill base. As dealer after dealer has said to me, half of my salespeople have never sold a car, they've just taken orders. My technicians are refusing to work on the weekends because the demand for them is so great. And how do I get, leaving aside the external trends, autonomous vehicles and whether AI, Skynet becomes live and kills us all, are important, but also how do I refocus on inside the store? Can I get F&I higher? Is there a way to source used cars better? Because I'm competing with everybody and their brother right now. So we'll be talking about back to basics as well in New Orleans, if it isn't washed away by the next hurricane.
I have to ask you before we go. You once worked for the CIA.
Yeah. Mm-hmm.
What does the automotive industry have on the espionage business?
Right. Okay. Actually, technically, I'm speaking to you as a representative of the axis of evil because I worked for McKinsey, evil consultants. I work for the Central Intelligence Agency, and I work for British Petroleum, big oil.
Oh,
So
boy.
I'm just tarred and feathered. Trifecta. I would say, working for the Central Intelligence Agency, I was on the Soviet desk. Some of your listeners may not recall there used to be a country called the Soviet Union. But it's now the Russian Empire reconstructed. I would say a study of how the Kremlin works was very helpful in trying to understand how automotive OEMs' central headquarters work, whether it's Stuttgart or Detroit. The Politburo model was It might be capitalist, but they ran it like the Politburo. So
I love it.
Helpful. Yeah.
You can find out more information at, is it Glenn Mercer at substack.com? Is that correct, Glenn?
It's actually glennmercer.substack.com. Yeah.
glennmercer.substack.com to find out more information. And of course, you'll see him at NADA in New Orleans. It's always great to be with you. Thank you so much, Glenn.
You're welcome, and thanks for inviting me onto the show.
Thanks again to my guest, Glenn Mercer, and thanks for listening to Full Throttle. Come back to us later in the month for our next interview on this platform. Email me with suggestions, jstein@thepresidiogroup.com, or go to the website, thepresidiogroup.com. You can follow us as well on LinkedIn. Thanks again for listening to the program. We'll see you next time.